This is coming at a time when you think Chinese markets have really kind of, taken a breather for the last few weeks or so. What do you think is driving that? Is it the technicals? Is it the geopolitics?
Yeah, I think the geopolitical issue is definitely a key reason that creates this market volatility. And we think when it comes to the geopolitical tensions in the medium to long term, when it comes to US-China relations, confrontation and competition will be the keywords. And the US will continue to impose restrictions on China, especially on the technology front. So investors should really take this into considerations when they are doing their long-term estimates towards China equities and even global equities. And we do think deglobalization and decoupling will be the key theme in this new era of emphasizing national security and economic security.
Okay, so what does it tell you about this rally, though? Is it an opportunity to buy on these dips, or do you think it's time to take some profits, too, after the rally we've seen?
Well, at RBC Wealth Management, we have a bullish view on China this year, and we do think the recent pullback creates opportunities to add more position. So for us, we think investors really underestimate how strong China's recovery can be this year. And at RBC Capital Market, we just published a research last week trying to quantify the speed and scale of China's reopening. And for example, the public transit data, right now we are tracking the data of 10 major cities in China. And a simple average data of these 10 cities now is above 100% of pre-2019 level. So the recovery actually came in very strong.
So we had Goldman Sachs coming out with a note saying, look, there is more juice in this market because what we saw in the last few weeks of 2022 was really more about multiple expansions.
Yes.
What needs to come next in this rally is earnings that have to deliver.
Yeah.
Is that reopening theme going to translate to better earnings for the later part of this year?
Yeah, we think the first part of market rally from November to January was mainly driven by valuation re-rating. And now the second part of market upside will mainly be driven by the earnings upward revision. So for the fourth quarter pre-earnings announcement, right now it's still coming in a little bit weak. But we think that actually priced in the one-off effect from the December reopening. And then going into this year, we have a very low base effect, a very easy comparison, and companies will continue to benefit from the recovery this year. So we are likely to see very strong earnings growth this year, and that will drive the market higher.
Yeah, we got Chinese tech earnings that kick off this week. What are you expecting in terms of that sort of consumer recovery? And do you tilt towards still those tech names?
Yeah, so we have a preference towards consumer names. We think they will continue to benefit from the reopening. And we also like the large tech names because we think that those will be the stocks that especially for international investors, they will like to buy those names when they want to invest in China equities.
Okay, and what about when it comes to housing then? That's still kind of the big, I guess you could say, wild card, whether we actually see physical and demand picking up in that sector. Is that a big concern still for you?
We are seeing very encouraging signs coming from the China property sector. For example, for the 70 cities' new home prices, they actually stabilized in January. They stopped falling after dropping for 16 consecutive months.
Yeah.
So we think the physical market recovery is actually very positive to solve the funding issue for many property developers.